Right, well, welcome to everybody that's watching, and I'm delighted to be joined by Tony Steels, the CEO of MPAC Group, and by Jim Haughey, the Group Finance Director. And they are here to talk not only about the full year results that have just been released today, but also their plans and ambitions for the group, which has seen quite a lot of change since you arrived, Tony, to say the least. So perhaps you would like to run us through what you see as the highlights of these results and your achievements so far.
Okay, thanks, Andrew. Well, yeah, we've used the word transformational this year, and I wouldn't use that word lightly, but I think the divestment of the instrumentation and tobacco machinery business was really important strategic step for us. Why? Because for me, it accelerates our strategy on quite quickly. If you look at last year when we did our strategic review, we classified that part of our market as cash generation, looking to maximise the cash and the revenue to support the growth in the packaging machinery. So selling the business for a premium really just accelerates that strategy on and puts us in a position now where we've got the cash resources on the balance sheet in order to invest in the organic growth of the business and to potentially acquire businesses that fit in our strategic plan. But during the year, I think other things that we were doing also occupied our time. We moved our business in Mississauga, about 10 kilometres up the road, to a new showcase facility, which will really elevate the customer experience there. It's got an innovation centre. It's got like a campus type feel within the building for the members of staff. So that will help with the cultural improvement of the business and to attract the new generation of engineers, software engineers coming out of university. And we also moved our business in Singapore. As a result of the sale, we sold that part of our business, and we started a new facility in Singapore. We've got about 15 people there. And on the continuing business, with having all those other things going on as well, I think we made really quite good progress in terms of the order book. Our order intake increased by 21%. We had a sales increase of 38%, and we managed to turn around the profitability from a loss generation in the continuing business last year to a profit situation. So the first steps in our strategic plan, I think, are quite positive. You'd say the order intake part of it, the growth, going for growth, the first swallow doesn't make a spring, so we've got to repeat that year on year now to make sure that we can consistently grow. And our attentions over the next 12 months will be firmly around the make service business proposition to really get some momentum behind that. Now we've got John Clifford with us, our new services director, and to focus on operational efficiencies to improve the ROS over the next couple of years from the 2.4% we were at last year up towards that double digit that we've got in our strategic document. So overall we can say that we're pleased with progress, but we recognise that there's an awful lot to do, and I'm really delighted with the new team that we've got in place and the commitment they're showing towards our strategic plan and the early stages of delivery that we've seen.
And that order book must give you a lot of confidence looking not only for the rest of this year but going forward, because you're in a good position to see what is coming up in the next few months.
No, that's right. Last year I think at the same time we was quite pleased with the order book going into 2017. This year it's better, so we're in a better position to be able to look at this year and know that we're on track for to meet our growth targets again. But as part of the going for growth strategy last year, we spent an awful lot of time and investment on the sales team, taking them through a professional sales program training, and on the back of that we upgraded our ERP system and embedded within the ERP a new pipeline management tools, so that we've got much more visibility of the order prospects looking out over a 3-year horizon. So we've got visibility now. Is our sales pipeline better, worse, the same than it was say a month ago, 3 months ago? And that gives you an awful lot more confidence of where the prospects are and where they're likely to drop. So you're not saying everything's rosy in the garden, but that visibility certainly helps us to plan the business and to make sure that the projects that we have in the pipeline, we're in a better position to execute those whilst maximising the profitability that we took the project on board at.
And what's the client reaction been during your stint here? As you say, substantial change of focus away from the tobacco manufacturing side to the new focus on packaging machinery. Looking at the sales figures and the order book, it seems like the reaction is very good. Are you essentially now fulfilling, if not an unmet need for these clients? Are you bringing greater standards of quality and reliability?
The reaction from the customers has been very positive, I have to say, and the rebranding towards MPAC, not only a name change but a rebranding, has also been met with a great deal of positivity. We've retained the Langen name, as you probably see in on the website, which is a huge positive for the packaging machinery business because it's a very renowned, a highly regarded name in the industry. So the initial reaction from the customers for the divestment and the rebranding has been positive, and now they can see, we're having regular conversations about the new focus of the company. We're talking now 100% focused on packaging machinery solutions. We're talking about service packages and programs tailored to suit our customers' need. So our relationships on the back of the changes in the company, we're beginning to develop deeper, more meaningful relationships with our global customers.
And it sounds as if that growing focus on service and software will lead to a more recurring relationship in terms of order flow from these clients.
That's the tendency that we're following. I think I've commented before that I don't think there's going to be any huge mechanical leaps forward in technology on a mechanical basis, or probably on electrical engineering, but the whole software and the control of the packaging solution, the data harvesting, and then being able to use that data to feed back relevant information to our customers is clearly the key. And I think one feeds into the other and would help to support our service proposition going forward.
Yes, would you think any consumer-facing organisation must be very concerned about how their product's presented and, of course, delivery of that product on a timely basis?
Yeah, I think the drivers that we're seeing within the marketplace is increased product variety, so quick changeover from one size to another, and ideally doing that in an automated fashion, so the machinery can be remotely calibrated to change product size at a specific point, and then managing that throughout the production cycle so that the cartons change at the right point and the output labelling is correct to the right cartoning. That challenge, whilst it sounds quite simplistic, doing that at high speed is really a differentiator that we can offer to our customers.
And then do you think you'll see a broader spread of customers going forward, or is it a case, because you do have some very large customers, the likes of Glaxo, Nestle, Unilever, of doing more with the core relationships that you already have?
There is an awful lot, I think, further potential with our current global key customers, as we describe them as, because there are facets of our business that they may be not aware of yet, and the full solution provision that we can offer them. But that can then be taken into the market, into the adjacent customers. So, for instance, we do quite sophisticated solutions for coffee sticks, and our primary customer at the moment for that is Nestle, but there are other customers, particularly in Asia, that do a very similar product, and we can also offer similar solutions. So it's looking at the adjacencies, it's looking at the competitors of our main customers and seeing where our technology can help them to develop as well.
And presumably when you develop a new technological solution for a client, you're free to market that solution to others active in that sector?
Yes and no. There is quite often when we're dealing with a customer with a innovative leading edge technology, there is primary IP that the customer doesn't want to disclose beyond our relationship, but behind that there is the sort of background enabling IP, which is something that we retain, and those process control techniques we can use in other industries, in other applications. So we've got a rich heritage and portfolio of engineering solutions that we've been able to apply over a number of years, which forms the basis of our current catalogue of solutions that we can offer to customers from the businesses that we have today. Yeah.
And how excited are you of building on that heritage? As you say, some very established brands and IP involved. At the moment, a nice progression in sales growth and margins moving the right way, but how much further can they go?
Yeah. No, so I think my comments last year was that I was really excited to join the company 18 months ago and to see the potential within the company in terms of the blue chip customers, the engineering solutions we have, and the opportunities I had early days to meet with the people, the employees of the company and the team. They were all very motivated and excited. 1 year further down the road, I've certainly met most of our employees around the world several times now and met an awful lot of customers, and my excitement for the business is undiminished. I see as much potential now, in fact probably more, because I can really now understand, I think, how the technology is applied by our customers and what it is that what they're looking for in terms of to improve their production output. So I'm really delighted by the team that we've put together, the leadership team, and I know as a group we're looking forward to taking on the challenges of delivering on our strategic intent over the coming years.
And how happy are you with the current shape of the group? First of all, addressing that in geographical terms, that you mentioned global clients, big multinationals. Yep. You've already referred to your activities in Canada and Singapore. Do you have the right profile to accommodate their needs going forward? Yeah,
it's very important that we maintain our global structure that we have in place, and it is referenced in the document here. And why is that important? I mean, some people could say, well, you stretched a bit thin, but our customers absolutely look to us to be able to provide that global cover, not only for new projects but for service. So having the businesses located where they are and having our service technicians in the parts of the world they are, it really helps us to differentiate and to support our customers wherever they choose to set up a manufacturing facility. So it's important for us. We don't think in the medium-term plan that we'll need any more locations, but we'll certainly grow in those locations to further support our customers.
Mm-hmm. And you're talking about the medium-term plan. You're on record of saying that over the next 3 years you'd like to see growth of 10% and the volume level and a return on sales of a similar number. Yep. Can you give us a little more flavour of whether that can be achieved organically, whether you're looking to do bolt-on acquisitions, and if it is going to be done organically, where you think the volume and margin enhancements can come from?
Yep, sure. So the 10% growth, we demonstrated last year, and as I say, one swallow doesn't make a spring, but we demonstrated that we can grow the business beyond the double digit. So that's I think it was a good statement of intent that we're in the right direction. We now have to repeat that year on year. We are a relatively small company in what is a vast market for packaging machinery. We are market leaders in some of the areas where we focus, but the market potential I still see as huge compared with the size of our company. So I don't think there are any barriers to maintaining that double-digit growth in the medium term. Coming to the return on sales, last year's result was a fairly modest result, given that we had a number of other things going on in the company. But we've got a number of projects running through the business where we feel that will absolutely impact positively on the margins that we earn. One of them is the volume growth in the original equipment and service, and that will have a margin improvement directly from that towards our return on sales. Another one is a supply chain project where we're looking at a global supply chain. Well, what does that mean? People say it's well understood in our industry. If you order one set of machinery and you order 3 sets 3 months later, there is quite a price discount to ordering 3 sets of equipment. So organising our business around modules and ordering those modules in recurring volumes will have an impact which we see also come into the return on sales. And then the third element is an engineering project that we're running through the company to try and bring our businesses onto a common engineering platforms so that we can collaborate together on projects, we can share our portfolio of engineering solutions and work simultaneously on the same projects. That type of productivity improvement will also have quite an impact on the way we've managed projects and our engineering resource, the utilisation of that engineering resource, which is one of our more expensive overheads within the company.
So it does sound as if a lot of the cash that you have accrued from the disposals is going to be used internally.
Not necessarily. We will use some of it for our organic growth and to support that with necessary equipment, necessary resources. We have got quite an active product development, but a lot of that is engineering time, not straightforward outside investment. So we hope to retain the large proportion of our cash for potential acquisitions going forward.
Mm-hmm. And is there any particular area, you've alluded to the potential to add on more revenue from services going forward, and an investment in software to bring more quality of service to clients. Is that an area that you'd be looking at?
In terms of new product development,
In terms of acquisitions.
In terms of acquisitions, our primary focus is to look at the our current solutions that we can offer out to our customers, and our Coventry-based business is very much at the leading edge in first-of-a-kind concept engineering solutions to customers, and then our Dutch business and our Canadian business is focused on the secondary packaging, tertiary packaging solutions. So there is a potential gap, and there is a gap between the sort of first-of-a-kind concepting and primary packaging that meets with the secondary packaging. All sounds very complex, but there is definitely a gap there. And our sweet spot, if you like, would be in the pharmaceutical healthcare markets, to find a business that does primary packaging in that space and would work well with the rest of our product solution.
Mm-hmm. And pharma and healthcare are substantial parts of your overall group volumes at the moment, but are they areas you're looking to grow in total?
Yeah,
presumably they're better margins, they're regulated, there is a lot of care and attention to the products.
Yeah, it's currently around about a third of our business is pharmaceutical and healthcare, and it's certainly an area where we're putting an awful lot of our focus for product development roadmap for the development of our service solutions. That's the primary area we want to build up first, and then we will cascade that through the rest of our products. So it's certainly the focus, yeah.
Okay. And before we go on to Jim to look at the results in a little bit more detail, obviously today you decided not to recommend a dividend going forward for strategic reasons. That seems quite a logical decision to look at impartially and make, given the scale of opportunities. Was it something you discussed with your largest shareholders beforehand, or had they already bought into the growth and investment philosophy?
Well, last year when we for the first time we didn't pay a dividend, we did discuss it with our larger shareholders, and they were very supportive. They can see that we want to, if the word turnaround was used quite heavily last year, there was a necessary process to undertake within the company of change and bringing the company forward onto a new platform. That process has started. We're making good progress, but it's just started, and we need to deliver this now consistently. So I think in line with last year's decision, it's a continuation of last year's decision to retain the earnings as much as we can within the business to support the future growth and to invest internally.
Yeah, well, consistency of strategy is just as important as the original strategy.
Absolutely, absolutely.
Great. Well, thanks, Tony. We might come back to you in a minute, but perhaps now we can hear from Jim about the numbers.
Okay, thank you very much.
Right, Jim. Good to see you, and you make Tony look like a veteran here, because he's been here nearly 2 years, but you're now 6 months into the job.
6 months into the job.
Quite a nice task here to present these figures. Perhaps you'd like to pull out some of the highlights for us from the...
Okay, well, the highlights of the first 6 months, what have I found when I got here? The first thing is, I see this as a very solid business. The high level of technical expertise with the people that we've got. We're following the right sales strategy. I'm sort of happy with what I've found. I think this business has got great potential going forward. Okay, digging into the numbers a bit more. So first thing, order intake increased 21% year on year. The closing order book is 35% ahead of where we were last year. And in the year, we've seen a 11.9%, 29% increase on sales year on year. I'll go into that in a little bit more detail in some slides going forward. The underlying PBT was in line with city expectations. We recorded a number of 1.1 million. That's a 2.6 million increase over the figure that we recorded last year. The closing net debt, 29.4 million. Now that number's been bolstered obviously by the proceeds on the sale of the tobacco business, and it's also been bolstered by the proceeds on the sale of our Canadian property of 6.8 million. Moving forward, the next slide I've got to present goes more into the details of the change in revenue on a geographic basis. So looking at each of our regions individually, The Americas, the sales increased by 3.3 million, which is a 17% increase in turnover in that sector. In the European business, that increased by 4.6 million, which is a 29% increase in turnover. And the Asian business, that did very well. It increased by 4 million, which is a 69% increase in activity in Asia. Splitting the numbers in a slightly different way, if you look at our segments, most of the sales growth, 11.6 million, came from the OE business, the original equipment business. That increased by 29% year on year. The rest of the sales growth was modest growth in the service business. That was about 300,000. That modest 3% growth, you do have to bear in mind when considering that number that our services director has been on board since July, and in the second half of the year he was building his team, and most of that new team came on board in the November-December period of the year.
So that seems to tally with what Tony was saying about additional services being an area where we can look forward to good growth this year and going forward. Hopefully
in 2018 we should see the real impact of that team making a big difference in our service revenues going forward. Okay. Our next slide, that deals with group profitability. And as you can see, the gross profit that we added in the OE business where the significant sales growth occurred, £3.8 million. That is a profit drop through of about 33%, which is quite a significant margin. The service business, that did go back slightly by about 300,000. There was a change in mix in the service business away from higher margin spare parts sales towards sort of more normal margins, additional equipment sales, and that did mean that the year-on-year margins reduced slightly.
Is that just a happenstance of time, or is that a trend that you might see continuing?
No, it really depends on how the orders fall year on year. There's a different mix of orders all the time, and it really, at the year-on-year comparisons with the previous year, before we've got the new impetus from the service team, that really is just a function of the way the orders fall.
Understood.
Okay. Year on year we saw SD&A expenses increasing by approximately £1 million. Included in that, there was some non-recurring credits from the previous year. The numbers from the previous year included a release of around about £200,000 in legal expenses, legal provisions, and there was also some R&D credits of around about 200,000 that didn't recur. We took the opportunity to invest in some consultancy costs. That was around about 300,000, and strengthening the management team cost us around about 200,000. The rest of the million was made up of inflationary increases of around about 100,000, and that brought us to our 1.1 million PBT. Okay, moving on to the next slide. We talk about cash flows. We started the year with a balance of 800,000. We added our normal EBITDA, which is around about 2.3 million. Again, we had the impact of the property disposals in Canada, which was 6.8 million of proceeds, and the proceeds from the disposal of the tobacco business, which was 25.9 million. The disposal of businesses before they were sold contributed 4.4 million. And then we had 4.9 million of payments to the pension schemes. Now that's quite a large number. You have to bear in mind when considering that number that we made an agreement as part of the disposal that 2.4 million will be paid into the UK pension schemes as part of this disposal.
So that'll be a much smaller number this year.
That will be around about 3 million going forward.
Thank you.
Okay, we also saw a working capital outflow in the year. Our business is order-based, and there is swings in working capital. Last year they made great efforts to try and maximise the cash position at year-end. We made those same great efforts this year as well, but the timing of the order intake meant that one significant order with a significant customer of ours moved into February, so we didn't quite have the same profile of receipts going forward. But you do have to bear in mind that the business has traded up by 30-odd%, and so you'd expect there to be a working capital outflow in line with that increase in trade.
Understood.
Okay, moving on to the next. CapEx, we spent 1.6 million. In those numbers, we've got approximately $1 million, which relates to the fit out of the new Canadian facilities. There's also approximately 100,000, which relates to the new office in Singapore and the fit out of that facility. Okay, we spent also about 800,000 on reorganisation costs. We did take the opportunity in the year to change out the management teams in our Canadian facility, and we've also made some significant changes to our Beacon facility and also strengthened the sales team significantly. And that brings us, give or take, down to our closing net cash position, which is around about 29.4 million.
Nice surplus to have.
Okay. The next slide we've got is our 5-year revenue chart. Now the main message to take away from here is this 3 consecutive half years of revenue growth, and we're basically trying to lay our track record down here, and we're showing that there's three half years in a row there's been revenue growth. Okay, well that really deals with the main financial numbers that we have. I'll sort of hand back to Tony, who can sum up where we are, and that's hopefully it going forward.
Thanks very much, Jim. Right, well, perhaps Tony can just round up the hopes and expectations he has for the year. I have one quick question first, Tony, which intrigues me in terms of the changing dynamics of the packaging industry. A lot of profile for plastic being dropped by the major OEMs and consumer bodies these days. How do you think that would affect you, or maybe it already is? Is MPAC particularly well placed to profit from this change?
I can only see it as a positive, because if any changes to the packaging materials would have a consequence or a direct consequence to the packaging machinery solution, which would either necessitate an upgrade or even a change in the line approach. So for us, it can only be a positive. Once you take out the plastic content of quite a bit of the packaging products, you have to replace it with something, and then that would require a different technical approach to the packaging solution. So for us, it would be a positive.
Good. And to finish, perhaps you might give us a hint about what investors might be looking for through the course of the rest of this year from MPAC, and just how confident you are as the man in the hot seat on hitting these very attractive but hopefully not too challenging 10% growth targets.
Yeah. Oh, it's been a transformational year in the last 12 months, and I think we've made excellent progress with our continuing business, the packaging machinery business, towards our strategic goals. But it's early days. We've had a good full year at it, and we had a number of other challenging things to do in the same year. We don't have that backdrop this year. We've got the new team in place. I'm delighted with the team that we've got. I'm really excited by the challenges, and I know they are. We've cascaded down a lot of these objectives. We had a conference recently with our senior leadership from around the world, and we spent a couple of days having some serious work sessions on this, but also a bit of fun. So I'm more convinced now than I was, let's say, 12 months ago, that the team are getting the strategy and working collectively in the right direction to deliver on that. So good progress up to now, I would say, and we're looking forward to the challenge going forward and delivering on our expectations over the coming years.
Well, amen to that. Thank you both for your time. And for those of you who are interested in seeing all the slides that MPAC have put together for this results presentation, they are available on the MPAC Group website. And for those of you who want to see an interpretation of the group's prospects, there is a full research note written by Paul Hill available on the Equity Development website. Thank you.